Money Radio for a really great future. We're talking real money.
Well, if you're one of those folks who absolutely loves a volatile market, just craves huge losses, the excitement of big ups and big downs in your portfolio, well, folks, you really need to get in on the latest hot craze on Wall Street, and that's leveraged ETFs. Heavily leveraged exchange-traded funds. Nothing could be more exciting and more frightening than these strange, hybrid, bizarre investments. Hello, everyone. Hello, everyone. Enunciate Don. I'm Don McDonald. That's Tom Cock. He's in the Bellevue studio. I'm in Florida, and we're here to talk real money.
Yeah, and it's strange that you would say that's one of the most exciting things as a guy who just went to Disney World. I mean, they got exciting things there, right, that are way better than
No, actually,
ETFs.
Disney's pretty middle of the road. They're pretty tame.
Okay.
If you want excitement, you go to Islands of Adventure. Or not Islands of Adventure. What's the new park?
Twist You, Turn
Epic
You.
Universe.
Yeah.
You go to Epic Universe.
I don't.
People die on those rides.
Okay, well, that's excitement. Yeah, wow. Oh, fun.
It's kind of like the leveraged ETFs. I mean, come on. There are ETFs. Well, there are stocks. There are bonds.
Yes.
There are ETFs. There are mutual funds. Those are pretty much middle of the road kind of. Even buying individual stocks is tame compared with leveraged exchange-traded funds.
Yeah, and it's by the way, leveraged single stock exchange-traded fund.
Yeah,
single stock. And this has gone from 0 3 years ago, nothing, 0, it got approved 3 years ago, to $40 billion.
That's real money.
That's a lot of money. I don't care who's, et cetera, et cetera. So, and why have they got? Because you said the ups and downs, more of the ups. I think people think they're going to get rich by buying Tesla at levered up by 2 times. And the companies that are pouring them out, there's 701 of these funds now. There's 200 more that have been added this year, because guess what? The funds typically collect 1% to manage this leverage and this crazy method. $40 billion in 3 years, 700 funds. And here's the part that they don't tell you about, or they don't highlight, I guess. Most of the people that invest in these, they lose money. We've got some fascinating examples of how difficult it is to make this work.
Yeah, this is from a recent article in the Wall Street Journal by Jack Pitcher. And the returns on some of these lately, for example, let's use one of the hotter individual stocks with crypto enthusiasts is MicroStrategy, now known only as Strategy. Okay?
Soon to be only known as G, but we'll get to that later. Yeah,
or just Y.
Why not?
This is a company that really is purely a play on Bitcoin. Basically, they put all their money into Bitcoin. And by the way, they borrow to buy Bitcoin. So you kind of get a double leverage whammy from the Strategy ETF. And this Strategy ETF, it's really interesting. Strategy itself, its 1 year return as of October 23rd was just under 20%.
Yeah, the example used in the article is 28% for the last year. That's a pretty good return.
But they're the 2x long, which means they're not short. They own the stock, but they borrow money to buy the stock. It's down 65%.
Now, make sure we make that clear with people. So, had you just bought and held Strategy, which we don't recommend, by the way. I don't want to pile my money into a Bitcoin, et cetera. But up about 30%. Had you bought the more exciting and certainly looks great on the upside, 2 times levered fund from Defiance, down 65%. Now, let's walk through how that indeed is possible. That doesn't work.
They can't work.
Go through the numbers for what they call volatility decay.
Yeah,
you've heard of tooth decay.
Volatility decay is really interesting. If you look at the chart of a leveraged ETF, you'll see that when they go down, of course, they go down a lot. The problem is those big declines erode the fund's ability to make money on money, which is the whole point of buying securities. You reinvest, you build wealth on top of wealth. If you hold these for long periods of time, that leverage, that volatility, erodes your return. They call it volatility decay.
I mean, we used to have urban decay, tooth decay. Now we have volatility decay.
And I love this example because it's very clear. If you have both, you look at both the stock and the leveraged fund, and they start the week, the share price of the stock is $10.
Yep.
If the shares fall 30% on Monday, the 2X leveraged fund falls 60%. Okay? Now your $10 has fallen to $4. So now the next day, the stock goes up 50%. Now it's trading at $10.50, the stock itself.
Yep.
But your 2X ETF, even though it doubled, it's now only back to $8.
So look at those two numbers compared to $10.50 compared to $8 on one trade, really, basically, right? One round trip, if you wish.
Right. It's like when you go into retirement with a portfolio and it goes down right away. It's that sequence of return risk. If your downturns happen early, which is bad luck, but it can happen, the effect of that can be long-lasting because it takes longer to recover from a major decline. And that's what you see when you own these leveraged portfolios. You have the potential for a big upside if everything goes your way, but if it doesn't, you've got this huge downside, and that downside impact can linger way past just that 1 or 2 days of volatility that may have been extraordinary.
Yeah, I mean, in sequence of return risk can be worse because you're pulling money out of the portfolio while the portfolio is going down, so you're drawing from securities that have gone down. Here's the part that makes this even worse to me. When the short sellers look at this and go, hey, wait, this is quote-unquote a material winner. David Einhorn, pretty well known, has been shorting the leveraged MicroStrategy ETF in a trade. He says these products are destined to fail over time. They're likely to bleed out their capital. And by the way, some of the new ones, if they lose 20%, I think, or more in one day, they said they might. If they go to zero, that's it. They just close the fund. Volatility shares.
That's nice of them. They don't let you go below zero?
Exactly.
Oh,
your capital's risk is only what you invested and nothing more. Volatility shares filed paperwork to launch 27 highly leveraged ETFs, including what would be the first 5X funds. So 2X, not enough. 3X, no way. 4X, 5X.
And
now run the numbers on what you said earlier.
You're going to love those.
Yeah. Such funds would likely go to zero and be liquidated in the event of their underlying stock falls 20% in one day.
And here's the thing.
One day.
Leveraged fund managers will tell you right up front, if you ask them, they will tell you these are not long-term investments. Well, wait, then if they're not long-term investments, what are they?
Well,
funny they won't say the word, but what are they?
Well, I think you know the word leverage is gambling. Single stock is gambling. Short term?
Gambling.
I mean, diversification? That's kind of investing. Long term? That's investing. And tuning out the noise, not paying attention to when to buy or sell 2X Tesla or Strategy or any of the rest of them, that's investing too. And you want to be an investor, not a gambler.
Yeah, and the fact of the matter is if you're expecting somebody to protect you from these kind of products, you're going to be disappointed. There's no protection. The SEC allows these to exist. They are allowing new ones to start up, and they're going to be there. So it's up to you to avoid the temptation, to avoid... And I know you don't crave the downside. What you crave is that big potential upside. You got to keep your greed in check. If you don't, you're going to be in trouble at some point.
Big trouble. I mean, and as you said, I read one article outside of this one about these products. And, of course, what did they say? Though they should only be used for 5% of your portfolio.
No,
I love that.
I mean, okay, you got $1 million, right?
Yep.
You got $1 million. You've saved all your life. You've got $1 million, which does not, by the way, make you rich anymore. We've talked about that.
Yeah.
You got $1 million. I want you to look at it this way. Would you get on a plane, fly to Vegas, and blow $50,000 in a casino? Would you do that? If the answer is no, then none of your portfolio should be in these.
I would, but only if LeBron was there next to me, gambling it up or something. I mean, with a big name, be fun.
So that's worth $50,000 to you?
I don't know.
You are.
I'm not a gambler. You know that. I'm such a wimp when it comes to that.
See, I wouldn't pay $50,000 to hang out next to anyone.
Yeah, no, that's fair. I was making a poor joke.
Nobody's worth $50,000.
No, sorry about that. So
not even the Jonas Brothers.
Oh my good. Oh, we're gonna go there, are we?
No, we're not.
Yeah, okay. No, we're not going.
No, because then you make
his
fun
daughter's
of my
in town to see the Jonas Brothers.
She flew from New York to Orlando to see the Jonas Brothers.
By the way, that's an interesting place to look for a job. I didn't know that there were a lot of employers that were at the concert, but I guess it's a potential.
Don't be mean.
Okay, I'm sorry.
Do you have questions?
Slings and arrows.
Just go to the questions.
Shutting up now, sir. From Huntersville, North Carolina, Shay writes, "Is this a crazy idea?" I'm hearing yes already.
Yes, Shay, it is. It sounds like it from the get-go.
Would it be genius or stupid, he says, to have a high-yield emergency cash fund, say $180K in a 3-year EF, to draw from in individual months where the market is down steeply, like 6%, and therefore to have more stocks for growth? In other words, to have a lot of risk in stocks and then have a more set aside in a high yield. When you say high yield cash emergency,
I think he means high. I'm hoping he means high yield savings and not high yield bond fund.
He said high yield cash emergency fund. Now, and then he said EF. I'm not sure what EF refers to, but I figure if I could hedge some of my retirement funds with a cash option, I don't need 40% bonds, maybe more like 30%. Or it would be best just to go with the usual safe retirement at 60-40 mix with a 1-year EF of 60K while moving the remaining 120 to a stock bond ratio. In other words, having more in cash. I'm not a fan of high yield because when you say high yield, that makes me, there's a risk to that. And if you're going to have an emergency fund, it shouldn't be risky. And
I really think we have a communication breakdown here because I truly don't believe he means high yield. I think
he says high yield in it. He said large high yield cash emergency fund. Oh, yeah. EF is emergency fund. Okay, I get it now.
Yeah. But what I think he's talking about though is high, because we talk about it as that all the time. High yield savings account.
Yeah, that's different. Matter.
I think he meant to put the word savings account after high yield. I don't think he meant bond fund, high yield bond fund.
But have more set aside there so you don't have to draw from your portfolio when it goes down dramatically. Yeah, that's not a bad idea.
It's not a bad idea. It's hard to do.
It is hard to do.
We believe it's very hard to do in practice. Yeah, if you have 3 or 4 or probably 5 years worth of income set aside in something very safe, then you could ride out most worst case scenario markets.
Yeah.
And but you got to have a strong stomach.
You do. And so, again, the 60-40 aspect is not necessarily portfolio survivability. It does have something to do with your stomach, as you said, Don. And we know people in retirement, their tummies get more nervous because those are the assets they got left, right? There's no more income coming. So got to be really careful to know your risk parameters, taste for risk, all those things in retirement. So, yeah, I'm okay with doing that, but I don't know that I'd be telling you to take more risk necessarily in the other part of the portfolio because maybe you can take it and maybe you can't. By the way, he adds, Anthony, that's weird now. He says from Shea Carter, but then later says Anthony. Okay, well, anyway, he says, thanks, guys. Anthony in Huntersville, North Carolina. By the way, he says, it's good to find people like me who share in my love of money nerdiness and cornball humor. Now, I'm assuming he's referring to your humor when he said that.
Oh, yeah, of course he is. Mm-hmm. Yeah, all of our audience knows exactly to whom he's referring.
Who the cornball really
is. I'm pretty sure they all know.
Yeah, okay, fair enough.
Because how long have you been doing this?
A lot of cornball.
As long as they have the voice down and they know that who's the voice. I'm Don. That's Tom. You tell me who the cornball humor applies to.
Erupts from. He didn't want to use his name. We'll use initials PG from Tracy, California.
Okay.
He says, with one of the larger brokerage houses, I have $15 million in a non-advisory brokerage account. I also have an inherited IRA of $2.2 million that is managed, and 2 other IRAs with about $900,000 each also managed. So that's 1.8 plus 2.2. So you got about a $4 million managed account, $15 million he does on his own. Finally, he has a SEP IRA of about $5 million of a non-advisor managed. What are you, just writing to brag?
Yeah.
Anyway.
Okay, congratulations and thanks for your note.
You win. We're going to... Okay, my question. Is it proper to ask for a reduction in my advisor fees? Do my non-managed account have any value to this firm because they do not generate monthly income, only when I buy and sell stock and generate commissions on the transaction? Current fee is 1%, but I feel it's high based on performance and lack of attention I require as one of their customers.
1% is too high.
For $4 million, that's way too high.
Yeah, way too high.
And part two, all this is negotiable, sure. Depends on the firm. You can walk in and say, look,
Now,
I'm
is
unhappy,
the
whatever.
$15 million of great value? No, but it is of value to them.
Sure,
because
they're trading stuff there.
If they're a big brokerage house, then they act as their own custodian, they act as their own trading desk, and therefore not only are they getting the commissions they're charging you, they're also getting spreads. And spreads can be more valuable than commissions.
Yeah.
So
if,
they're making
if I were
money.
I'd walk in and say, I don't want to pay this much.
I'd start at 50 basis points.
Yep, I think that's fair. Yeah,
I would
and my
go
guess
back and
is,
say,
guess what? PG,
if you don't
they're
give
gonna
me
say
50
yes.
basis points, I guarantee you I can find someone who will.
Oh yeah, for sure. At $4 million, absolutely. Interesting situation to have those sort of held away assets, and they're not held away, but they're not being managed.
I would really be curious. This is one of those things where I'd love to see what that $20 million in non-professionally managed money is invested in.
He says right down here, a leveraged single stock exchange traded funds.
Yeah,
and he's made
does not say that.
Here.
Again, remember the
Cornball
previous
humor.
caller, our questioner, cornball humor.
Okay,
Keep it coming. And one of the things you have to learn about Tom is you don't believe about half of what he says.
I'd say 2/3
because most of the time it's an attempt at a bad joke.
Yeah, or teasing you. Okay, from Saratoga, California, Subha. I hope I said your name right. Writes, I feel that IRTR, that's a stock or a ticker, is better given it seems to have lower drawdowns and less expense ratio. It's actively managed, so I'm not sure. He's in AOM. AOM versus IRTR. Now, IRTR is a target date fund with a 50-50 stock to bond ratio.
Yeah. And what was the other one?
AOM is a balanced fund with 40% in stock, 60% in bonds. Don has a slight disadvantage because I looked these up prior to the program.
Okay.
He did not.
Yeah.
Those are two very different funds, by the way. So to compare them apples to apples, I'm not sure.
Actually, in terms of their current portfolios, they're pretty close.
Current, but that can change with the target date. The 40-60, that's going to be the 40-60 now, tomorrow, 20 years from now.
Yeah, it doesn't
right?
glide path down.
No, it doesn't glide path. So I did not look at the expense ratios of IRTR and AOM.
AOM is about twice as expensive.
Okay.
But they're both cheap because the IRTR is 8 basis points and the other one is 0.15%.
Still, I think you said it once. We're talking pennies on. I mean, is it cheaper? Sure.
Yep.
But those are two very different funds. Would be the first thing I would look at. Then I would look at, which I didn't look at, diversification in terms of the equities and the fixed income. How is that distributed?
Well, okay,
rather
the
than performance per
diversification
se.
in the IRTR is huge. I mean, huge, like massively huge. In other words, it's the entire market. It's the entire market. It's bonds, it's tips, it's emerging markets, it's the developed markets overseas, it's the Russell 1000. I mean, you own thousands and thousands of stocks in this portfolio.
Okay, that's good, which is what we want. What about AOM? That must have been a step up from AOL, I assume, right?
Well, yeah, it's the next one in the alphabet.
It's easy to remember. Sure, yeah.
America Online to America on Mime. It's just when they
on Mime.
They don't
or on
speak.
Mime?
They went from
on me.
Went from the internet to miming performances in parks. See, that's why I leave the bad humor to Tom. Now let's look at the portfolio of AOM, and what do we see here?
This is not going to be good when he starts it with laughter, by the way.
Almost exactly the same portfolio.
Oh, okay. All right.
Almost exactly the same portfolio. So what's the difference right now, really? The AOM is 60% stocks, 40% no. Oh. What?
AOM is 40-60, I thought.
No, it's shocking. No? It's not. How can that possibly be?
Shows up at Morningstar as 40%, and I thought 40% stocks and 60%
U.S. equity
fixed income.
Yeah, actually, it's more like 56, 44. Yeah. Okay.
Interesting. So 56 stock and 44 bond?
No, 56. Oh, it's the other way. Yeah, 56% fixed income.
Yeah. Okay. Yeah, that's about what I thought. Yeah.
Okay. Oh, yeah, it's a 40-60, not a 60-40.
Yeah,
it's a far more conservative fund than the IRTR, which is about 50-50 right now.
Yeah.
Which IRTR is a little cheaper. And it glide paths.
Yeah, I mean, here's the thing about a 40-60. I would want to run my plan very carefully to make sure that that's enough equity exposure, because he's 3 years from retirement, to make it work for a long period of time. Because that much in fixed income, that's, you're a lot in something that should provide about 4% a year. So it's done better at 5 if you look back 100 years, right?
Yeah, I was going to say back 100 years, it's over 5.
Yeah, it is. But so that would be something I'd consider strongly. I'd want to make sure it worked in my plan before I ran out and bought it. I put it that way.
Well, yeah, and it sounds like there's no plan here, so there probably should be a plan.
Yes, there should be. If you're 3 years from retirement, absolutely.
Yeah. So, yeah, thank you for your question.
No,
and if you guys want to send in questions, it's really easy. Just go to talkingrealmoney.com and use that contact form, and you can type them. And they go to Tom.
And you can call us on Saturdays and listen to Don complain about no one calling us on Saturdays. It's always fun.
Well, you complain. You just do it quietly. I want to let everybody know.
That surprises me that you'd be the louder of the two, but okay.
Yeah, I just want to talk to people. I just get lonely.
Yeah, but send us your questions. We've gotten a lot of written questions. How's your recorded ones coming in?
Well, let's look. I haven't looked in a while.
He's been on vacation at Disney World, so he's really taken
oh my gosh, we drove.
Big trip.
We took a big trip. We actually went drove right over the Interstate 4. Drove over it. We didn't actually drive on it. And let's see.
I told Danielle about that, and she said, "How come we never get to go stay in Carnation?" I said, "Okay, we'll have to do that because it's a similar distance, about 20-minute drive or something." So big vacation
we're okay.
ahead.
We're not as good as we were before.
Okay,
I've got about 12.
Calls.
I've got about 12.
We're getting calls. Oh, that's good. So keep them coming. We enjoy taking the questions. Oh, by the way, another thing. Here it is. Hate to say it, November, because it's already dark all the time here and rainy and horrible.
We just started our fall. It just began.
So the temperatures dip below 80 degrees?
Yeah, exactly. That's when I go to jeans. I go from shorts to jeans.
Oh, my goodness.
When fall hits, which is usually right about November 1st.
So here's the thing about Seattle.
Mm-hmm.
Everybody gets way more productive now. It's kind of shocking because, well, you're inside now for like 5-6 months, whatever it is. So if you want some help, planning, if you want to help look at your portfolio, all that stuff, as we have said many times, many ways, we give you a look at your portfolio and we give you an hour with an advisor. Could be me. Absolutely 100% free. Tell them how to do that, Don.
Well, you go to talkingrealmoney.com and you
then
click on Meet an
Advisor.
Meet an
Advisor. That's it. I just didn't.
Oh, and you bring up an interesting thought that I have occasionally. I know I don't often, but I do occasionally. It has always fascinated me. When you look, for example, let's look at Europe. Okay? We look at Europe. The most productive countries in Europe are in what part of Europe?
Central Europe.
Central and Northern, right?
Yeah, right.
The Scandinavian countries, Germany.
Correct. Yep.
The least productive economies in Europe are?
Southern.
The Mediterranean
Get the message. Get the message.
Wait a minute. And, let's compare the number of major corporations in. I'm not going to use Seattle. Just let's use Minneapolis versus Miami.
3M. Et
Which one has more major corporations?
I'll go with Minneapolis.
Right. What's the difference between those two places?
Well, because everybody in Miami's out partying till 2 a.m., so you really can't get up in the morning and get your company going.
I mean, or if the day's gorgeous, what are you're going?
I'm going to go to the beach in Miami.
I'm going to blow off work today.
See you later. Yeah.
If I did not lock myself in this studio,
you wouldn't get anything done.
Nothing would get accomplished.
No. So thank you for locking yourself up. I'll be locked up in my office now for 6 months until the weather turns. 7.
Yeah, because what are you going to? You're going to go outside. You're just going to get soaked and cold, and you'll die of pneumonia. All right, thank you all for being a part of our podcast. Now go away and come back again tomorrow. Okay,
that's it.
That's it. That's all we have. We have another podcast that we're going to record, but that's it for this one. So now we're done talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.